Welcome to the Monocle Banking Podcast. I'm Michael Avery, and as always, we're unpacking the ins and outs in the world of finance, balancing the books, and this week we're unpacking the full year 2024 earnings of South Africa's big five banks, FirstRand, Standard Bank, Nedbank, Absa and Investec, and what their results reveal about the state of banking across South Africa and the continent. Despite a tough economic backdrop, all five lenders grew earnings, though at different paces. Absa led with a 10% rebound in headline earnings, while Nedbank and Investec posted solid high single-digit gains. FirstRand and Standard Bank delivered more modest 4% increases, but maintained robust fundamentals. Returns on equity remained strong, ranging from mid-teens at Absa and Nedbank to over 20% at class leader FirstRand. Three big themes emerge. First, the credit cycle. Impairments are easing and arrears seem to be stabilizing. Second, cost discipline. Banks are managing inflation surprisingly well, with cost-income ratios near record lows. And third, strategic divergence. Each bank is leaning into its strengths, from Standard Bank's Pan-African scale to FirstRand's digital edge, Absa's turnaround and Nedbank's renewables push, while Investec remains firmly with a wealth focus, playing to its core strengths. All of this plays out against a very complex macro backdrop, with the GNU trying to deliver growth in South Africa, and globally the market is on edge as Trump 2.0 ushers in an age of trade wars. And we've seen some currency swings in Africa, as well as optimism around potential rate cuts, as we hope to be entering a much faster rate cutting cycle with inflation cooling on the back of lower oil prices. Well, joining me to unpack it all are Rivaan Roopnarain, PwC South Africa's banking and capital markets partner, and Francois Prinsloo, PwC Africa's banking and capital markets leader. They've been analysing these results closely, and so we'll lean into their expertise. Welcome, chaps. Rivaan, I've got to ask you firstly, despite the weak GDP growth at home and the fact that at least we did see an easing of load shedding, South Africa's major banks still produced solid earnings in FY24. What does this say generally about the bank's resilience and the diversified nature of their income streams? Were there any common factors like elevated interest rates or transactional volumes that particularly buoyed bank revenues across the board?
Michael, it's great to be with you, and thank you for having us. Yes, indeed. And I think before I get into the specifics of your question, as always, when we look at banking results, we like to think of them within the context of the broader environment in which those results were achieved, as you highlighted. And if you recall, in 2024, what we had was a first half with quite a bit of uncertainty, largely as a result of elections across several countries, including our own in South Africa. And that played out with a sense of wait and see in terms of corporates making investment decisions and just economic activity more broadly. Of course, we then saw the electoral process running its course quite efficiently in South Africa. We saw the swift formation of a government of national unity. And with that, we saw some promising signs in terms of some of our more structural issues starting to abate. Things like limited to no load shedding, some logistics constraints in ports and rails being lifted, and we saw inflation starting to moderate, at least slightly below the SARB's target band in the second half. That's really important context because at the end of the day, banks are financial intermediaries that operate within the economic context, and they feel the strains and the opportunities that customers feel in that economy. So that sets the scene for the set of major banks' results for this period, a tale of two halves, as it were, pre-elections and post-elections, first half and second half. Michael, with that, we think South Africa's major banks delivered a resilient performance in FY24. That's reflected across a range of measures. And if I step through some of them, first of all, we see balance sheets continuing to grow. Both on the funding side, deposits were up just under 9% year on year. On the lending side, we saw gross customer lending up around 5.5%. And that tells you that consumer appetite for banking services remains in spite of the volatile economic environment that prevailed. And that provided the basis for banks to do more with customers, more processing of transactions, more deposit taking and more lending, which is, of course, the heart of what banks do. We saw very good top-line growth with continued revenue momentum across both net interest income and non-interest revenue. So volumes up, translating into higher fees, bank charges, and we see operating income as a result of all of that growing around 4.2%. We then saw, importantly, really strong contributions in local currency terms from the major banks' operations in the rest of Africa outside South Africa. And yes, they all have differing levels of involvement in the continent, but the underlying franchise momentum of their businesses in those countries continued. That was offset to some extent by currency volatility when you translate those results back into rands. And so overall, Michael, we see returns on equity being lifted from where they were at the half year in June last year and on the prior year, with combined ROE coming in at an average of around 17.5%. That is enviable by any global measure. And that's why we continue to describe this set of results as being resilient.
Absolutely. Those ROEs in South Africa do have some structural underpins as well, but we can be very proud of our banking sector. Francois, if we look at the asset quality and the management of non-performing loans, looking through FY23, we saw a spike in non-performing loans. I think it was to around 5.5% of gross advances. How did that trend play out in 2024, given that we started to see interest rates come down and that improving macro backdrop and geopolitical backdrop that Rivaan described?
Hi, good afternoon, Michael, and thanks for having us. I think it's important, again, context, credit risk, obviously a core part of bank management areas of focus. And if you do look at the 24 day results from a credit impairment, you've seen charges decrease 6.3% against sort of similar numbers in 2023. And that led to credit loss ratios falling to about 89 basis points compared to 102 basis points in the comparative year. And if you analyze the drivers behind that, you could probably attribute it to a combination of factors. And I think, firstly, as you know, the credit models are expecting a improved interest rate outlook going forward. And we've previously commented on the interrelationship between interest rates and impairments. We've seen in the industry some long outstanding non-performing loans being worked out or restructured, particularly in the CIB business. And then I guess generally improved credit trends in South Africa, particularly towards the end of the first half of 2024, and then particularly more so in retail banking with slower inflows into the loan portfolios, into what the banks normally called early arrears. And again, this has been also sort of managed through very effectively through proactive customer assistance programs and enhanced collection processes implemented by the major banks. So overall, I think operational efficiencies, a better outlook towards interest rates, and just general improved credit trends. And I think another contributing factor are also some of the large sovereign credit impairments that were evident in the previous period, either did not reoccur or incurred in a lesser extent. If you think about places like Ghana, where there's been new rounds of sovereign debt restructures. And so if we stand back, overall, the banks have commented that the credit loss ratios remains at the upper end of what they call through the cycle target ranges, which on average for the banks in our analysis are somewhere between 70 to 100 basis points. So I think certainly an improved environment, but it will continue to be a key area of management focus.
Francois, just to build on that, any particular segment, home loans or vehicle finance or credit card, that are still under stress in the broader basket?
Michael, I don't think there's something I particularly want to highlight. I think there is still some strain in the consumer within the South African economic environment. I think we come from a number of a period where the consumer has been under strain, and that continues. I think the improved interest rate environment is helping. I think disposable income is increasing. I think, like Rivaan has mentioned, there's a more positive outlook from the corporate side, particularly on the investment and expansion side. So overall, I think there's an improvement and there's a good management process around this from the banks. But I don't think there's any particular industry or sector that we've seen under more strain than the others. I think just generally the consumer, has had a tough time, and hopefully if the interest rates improve, and it could only go better.
Yeah, and that is encouraging. And we know, Rivaan, to bring you in on this, higher rates eventually drive higher impairments, and through the cycle it's to be expected. But given where we are in the cycle with rate cuts and possibly more on the horizon, that gradually improving economic outlook, do you expect banks to loosen the credit taps again, or is the watchword still prudence, especially with all of the uncertainties like the increase in VAT and the global volatility by the tariff wars that are coming out of the White House in the mix?
Yeah, Michael, it's a really good question. Look, I think it's fair to say that the management teams of South African banks have shown themselves consistently over time to err on the side of prudence and conservatism to some extent. The environment is uncertain. Some of the factors that you mentioned, I think geopolitics overall hangs broadly as a key uncertainty for management teams, geopolitical tensions. And when you have an environment of uncertainty like the current environment, the question becomes, what do our banks do when faced with that uncertainty? And in many ways, they do what they have shown themselves to do consistently through prior episodes of uncertainty. And that is to model a range of scenarios, probability weight those scenarios based on data and relevant information and be guided by the data, and then position their businesses and take actions accordingly to navigate through and preserve their strategic areas of focus. So that's precisely what we expect them to continue doing, as opposed to making, immediate portfolio or risk management type decisions just based on any one piece of information.
Looking at the cost to income conundrum, all the banks maintain cost to income ratios in the low 50s, with some even improving efficiency. So, Rivaan, given the high inflation, how did they achieve this? Where did we see the biggest cost discipline? I know there's been a lot of branch rationalization as banks go digital. Was it staff costs that were brought under control, leveraging that tech spend that really has been a big focus for the banks? Where did you see the greatest cost containment strategies through the big banks' earnings?
Yeah, so Michael, I think if we look at the combined cost to income ratio for the banks that we cover in our analysis together, it came in at 52.9%. That is slightly higher than it was in December 2023 at 52.4% at that time. And if you look at the operating expenses line for these banks, it's increased around just under 5% at a rate that's slightly faster than income growth. So that's driving the cost to income ratio upwards for this period. As you rightly say, strong focus on cost management continues. And when we unpack the key drivers of the cost growth, we find that there is close alignment with the major bank strategic areas of focus. So they are continuing to spend in areas that make sense for their strategies. And let me talk about those before I come back to where, they are potentially not spending. But areas of spend growth aligned to strategic areas of focus include things like cloud-based software and security costs, which are often dollar denominated. We see continued investments in technology to both digitize and enhance customer experiences on banking channels, as well as make the internal back office processes leaner, more efficient through automation and technology. We also see investments in the corporate brand, things like marketing and sponsorship activities. So those are where the wallets are being directed. In terms of how one achieves good cost management from a banking perspective, it really is in areas of discretionary spend, Michael. So if you look at things like the staff costs, which continue to be the largest contributor of the cost base overall, I think bank management teams are becoming more discerning around increases well above inflation, things like discretionary bonuses and just discretionary spend overall, things like the use of professional services, consultants and the like. That's probably where one tightens the belt as opposed to those areas that are strategically aligned.
And obviously, digital transformation innovation remain core. Banks spending quite heavily on, be it going into the cloud or better servicing their customers through greater utilization of data. And Francois, if you look at it, each bank investing heavily here and almost a slightly different journey. Nedbank completed its core IT managed evolution project. FNB's got an award-winning mobile banking platform. Are we starting to see clear payoffs from these digital investments in these FY24 numbers, for example, in customer growth or lower cost to serve and that kind of thing?
I think we will continue to see spend in these areas. And I think Rivaan has indicated, some of the areas, cloud spending, continue investment in technology. I think what we're also now seeing, and this is in various areas, is the investment in AI, which I think is sort of the buzzword in all of financial services. So we've seen that the banks not only talking about sort of potential frameworks around AI and governance, but really confidently exploring the use of these technologies and investing significant funds in this. And it's particularly around sort of, I think, three key areas. It's around sort of operational efficiency, it's around risk management processes, and very importantly, around customer experience across a wide range of user cases. And this is really consistent with what we've seen. We've recently done an analysis of some of the global banks as well. And it's been clear that what we've observed from the global banks, that those banks that really harness the power of AI, data, and highly qualified people are the ones that's really transforming their operations and elevating customer experience and with it exceed stakeholder experience. So back to your point, I think we will really see significant continued increase in tech spend. And I think the customer will experience that, the way they engage with their banks, the way their banks offer products to them, and the range of products they get from their banks. So we think it's a very exciting area and only very beneficial for the customer.
And you mentioned, having investments obviously in the technology, but also in the people. And I think having the skills to both be able to work with big data and understand the business case of core banking, marrying those two is going to give one a huge competitive advantage entering the world of banking right now. Rivaan, I've got to ask you to bring you back in, though, whether or not that is something of a bottleneck for the banks in South Africa, that kind of skills pipeline. And how do you see the banks addressing this? Is it a question of growing their own timber? Are they having to insource a lot more, partner with consultants? What are the trends?
Michael, the shift to digital banking platforms, the shift towards digitizing operations, and now some of the more emerging technologies that Francois alluded to has been in the making for a number of years. So I think banks have been planning for this. What they are doing at the moment to a large extent is incremental improvements in a digitization journey that began a long time ago. As part of planning for this program, and you alluded to Nedbank earlier, who started their journey, some time ago. As part of planning for these programs, they were conscious about the skills shortages in South Africa, in that area, but also the need to upskill, reskill existing staff. So to a large extent, I would say they've planned for this. Where there are shortages in skills or particularly emerging areas like generative AI, for example, I think that's probably more of a global phenomenon than it is a uniquely South African one. So there is likely to be a fierce war for talent in that regard. But I wouldn't characterize it as being a South African banking specific matter necessarily.
And Rivaan, just staying with you on the ROE leaders and laggards, FirstRand, once again, because it tends to top the class here, delivered an ROE north of 20%, as you mentioned earlier, well above peers like ABSA and Nedbank. I think ABSA around 14.8, Nedbank 15.8. What's behind FirstRand's consistent superior return on equity? What do they do differently, whether in risk pricing or cost management or the mix of the business that others are now trying to emulate?
Michael, I think we leave it to the equity analysts to talk about the specific institutions. But if you take a step back and look at ROEs generally, what drives high ROEs is when you have very good revenue generating businesses at very low capital consumption levels. And of course, within the FirstRand stable, you've got a massive retail banking business in the form of FNB, which over time has shown itself to generate the higher ROEs within that particular group. And it really comes down to strategic choices and investment decisions as well as timing. So I think the average ROE is probably more pertinent to analyze the banking sector overall as opposed to institution-specific choices. But ultimately, what drives high ROEs is if you've got capital-light businesses as opposed to things that consume a lot of capital, like investment banking, commercial property lending, etc. Those things consume capital under the Basel rules, as opposed to businesses that generate fee and commission income at scale with much lower capital requirements. So it's I think much more informative to look at ROEs through the cycle on average, as opposed to institution-specific ROEs at points in time every 6 months when they report.
When we look at some other themes, if we're not going to go into the specific banks, Francois, ESG and sustainable banking have been a theme for the last few years, and we're starting to see green shoots in the loan book, pun intended. It's evident. Nedbank touting 183 billion rand in sustainable finance, major growth in renewables lending. How are ESG imperatives shaping bank strategy and performance overall? Are we seeing a real pivot in loan books towards renewable energy projects and green assets? And does it come with beneficial side effects like lower credit risk or new investor appeal? Or are there maybe some other costs that just have to be borne as we transition towards a net zero society?
Michael, yeah, I think all the banks continue their focus on sustainability. And I think it's fair to say they stride in their line to align their strategies with sustainability goals, particularly in mobilizing funding towards sustainable finance and climate transition initiatives. You've seen all the banks reporting significantly and proudly on their achievements, and I think we will continue to see that role. I think there has been sort of a slight different view coming perhaps from the US on a change in focus in certain area, but certainly in the South Africa and our engagement with the major banks, it's for them a strategic priority. And they will continue to focus on origination, particularly, like I say, on the funding in areas of focus where they believe they can not only generate good returns for stakeholders, but also contribute to the community, to the environment, and so forth. So, yes, I think there's various stakeholders in this. There's obviously from investment society perspective, there's also the expectations and where capital is deployed, where investments are being made, and the banks are very conscious about it. I don't think we've seen the end of it. I think this road will continue, and I think the banks will continue the momentum in this.
But they do, Francois. I mean, African banks face a unique balancing act because you've got to finance development and energy security. Often the energy security is still linked to fossil fuels while trying to meet ESG expectations. How are the banks managing this transition tension?
You're 100% right. It's making sure we balance what is, from a society perspective, important in terms of the needs of countries, of people within the country, what they rely on versus the sustainability element. So I think the banks are thinking very carefully about how they transition and have a managed transition and a responsible transition, taking in consideration the need of society as well. So I can assure you there's some robust discussions around where capital is being deployed. But my sense is it's done in a very responsible way. And particularly in Africa, I think where we have unique challenges on certain countries being very reliant on fossil fuels, not only in terms of the revenue, but also in the societal impact in terms of jobs and people relying on it. So it's certainly not an easy journey. But, I think we'll probably see the banks continue to report extensively on this. But I think my short answer would be they think very carefully about it. They're trying to be very responsible given all the stakeholders in doing so.
Yeah. Rivaan, just to bring you in on that, I mean, how do you see it? How do you evaluate the bank's progress on their climate and social goals alongside their financial outcomes?
Yeah, Michael, I think we've seen over the last 2 to 3 years that there is a much more discerning focus on reporting, not just on financial metrics. And you see more and more the banks putting out different types of reporting qualitatively. At present, we don't have uniform reporting requirements around things like sustainability metrics. But of course, that is coming and it's driven by a number of global bodies. So I think in time, you will start to see more and more reporting on these non-financial qualitative metrics because it's clearly something that is the priority for emerging economy like ours, as well as the bank's stated intentions to support the continent through its own sustainability issues.
When we look now, Rivaan, at the Sub-Saharan African strategy, is that still central to South Africa's big banks' long-term strategic growth? And I know, obviously, with the Absa Barclays disentanglement and Nedbank and EcoBank having a difficult relationship, it's been a patchy strategy versus others like Standard Bank have really made a real good fist of it. Where do you sit in the Pan-Africa versus specialist focus? And what are you seeing through the various bank earnings now around the Sub-Saharan African strategy?
Michael, our sense is that there continues to be quite an intense strategic focus on the major banks' operations in the rest of Africa outside South Africa. That is driven by the fact that if you look at Sub-Saharan Africa, it is still growing faster than South Africa in terms of GDP growth rates. The other aspect to remember is that in many of these countries, you've got a demographic profile that is younger, that is mobile, that is digitally savvy, and that's the type of consumer that you really want to appeal to. So what we've seen is that the scale and competitiveness of operations in these high-growth African markets has emerged as a clear area of focus for the major banks. In some cases in this reporting period, those operations contribute in excess of 40% to overall group earnings. So it clearly is a sizable number. I think it's also fair to say Africa is nuanced and there are both significant opportunities in various countries. There are also some risks. And you see the major banks trying to balance market-specific sovereign risks with earnings growth. In this period, we saw things like weaker currencies in several key markets that depressed earnings. We see the regulatory environment in certain African countries being difficult to navigate through. And all of this plays a role in their strategic thinking. But on the whole, I think Africa remains a central part of the strategy.
And just as we wrap up, Francois, obviously looking ahead, the operating climate seems poised to improve marginally. South African interest rates, if you look at consensus, obviously they've begun to tick down. Consensus is for another 225 cuts this year, maybe 3. GDP perking up a little to around 1.5%. How are banks positioning themselves for this next phase? Do they expect a boost from easing monetary policy, perhaps a revival in credit demand, or are they going to balance that off against these new storm clouds on the horizon that are emerging thanks to Trump's trade wars?
Michael, I think as we see in 2025 unfolds, I think the South African banks are likely to remain focused on sort of what we call the deal priorities, navigating a challenging environment while capturing appropriate opportunities. And I think they've proven themselves well with doing this over many challenging periods. So building on the resilience theme that we spoke about earlier in our conversation, and we probably see a couple of contributors. I think interest rate relief will probably contribute to some credit growth and positive sentiment. So we'll see the banks, as they anticipate rate cycle cuts, they are poised to benefit from a stimulated economy and I think lending activity. I think the second point is you also raised it around digital leadership and innovation. I think it's exciting times for customers. They are going to be the net beneficiaries on this as they get more products at better prices and more innovative ways. And I think you touch on it, the Pan-African focus. I think, like Rivaan said, there's some fantastic growth and opportunities we've seen in Africa. I think a number of the banks that's got a good footprint in Africa are going to continue to leverage the opportunities there and make use of young and vibrant society that's keen on doing banking and engaging with the banks. So, I think the banks are well poised to benefit from the environment. And like I said, I think they've proven themselves worthy of doing that.
Well, that's where we'll leave it for this episode of the Monocle Banking Podcast. Thank you very much. As South Africa's Big Five banks step into 2025, they certainly do so on far more solid ground and in a continent full of contradictions and promise. One thing is clear, the banks aren't just reacting to the change, they're actively shaping it. Special thank you to Rivaan Roopnarain and Francois Prinsloo from PwC for their always incisive analysis. If you've enjoyed this conversation, be sure to subscribe and follow for more episodes as we track the forces reshaping finance from the heart of Johannesburg to the corridors of Lagos, Nairobi and beyond. Until next time, I'm Michael Avery. Don't forget to subscribe to the Monocle Banking Podcast.